Morning, everyone. So today I thought I'd talk about financing actually, because it's been in the news a lot and interest rates and going up and up and up. But at the same time, I thought we would talk about what types of financing, alternative types of financing that's available. So first to do that, let's talk about what actual kind of financing that you have for commercial properties. You have your conventional financing. This is typically through banks or credit unions. You have CMBS financing, which can also be through a bank or a life insurance company. You have angel investors. Okay, that's a very alternative method where they might be able to come in. Very kind of rare, a little bit, but there is that. And then you also have venture capitalists that will invest in commercial real estate on the finance side of it. And then you have private loans. That would be individuals or smaller companies that are not necessarily banks that loan and give financing out. And crowdfunding has gained a lot of popularity in the last 10 years or so. And lastly, there's seller carryback. So those are all the different types of financing. Now, typically speaking, when we're in a strong market, we very rarely see some of the other investing except for the larger deals. I mean, you have the venture capitalists and angel investors that may come in for a little bit of the larger deals, but generally speaking, in an up market, most financing is done on the conventional side or CMBS side. So you're dealing with banks, insurance companies, and credit unions. So keep that in mind. Very rarely do we see seller financing as well. And there's different benefits for each one of these. So let's kind of go into it a little bit. Banks are your traditional source of funding for commercial loans. Now, when a bank looks at the finances or the loan itself, one thing you have to be aware of is that banks, credit unions are going to be a little bit more concerned about the actual individual, their creditworthiness. They may look at the income as well, but they're really going to take a look at the creditworthiness, the bankruptcy issues, anything like that. However, the underwriting for the loan is based upon the property for commercial real estate, because they're going to be concerned about does the property cash flow. So they're going to underwrite the property more so than they will the actual investor coming in. From there, you now have private equity. Private equity, generally speaking, private equity, you can pull funds from different investors to purchase the property. And this can be done in various ways. You have LLCs, GPs, LPs, other type of entities that can actually be held under that format. What is different in private equity versus banks is that private equity typically has a share of the profits. And usually it's treated, at the very least, pari passu with the money that you put in. So all the money is treated the same. However, sometimes investors in private equity, the ones that are actually giving the majority of the money up, may get a preferred return. Okay. Private equity also doesn't mean that you have to raise 100% of the property value to purchase the property. You can also use private equity to raise the down payment and then use conventional financing for the rest of it. Okay, a lot of times that's called a sponsorship as well, and you'll see this with sponsors where they put in a little bit of money, typically 5 to 10% of the equity that's required to purchase the property. And so in this case, if it's a 40% down payment that you're looking at, they're going to put down anywhere from 5 to 10% of that 40%. Okay, so essentially, that's going to be 2 to 4% of what the actual total equity required. Another big difference with private equity and financing is if it's a long-term hold. Very rarely do we see long-term holds because a lot of private equity investors want their money out, but it can still be structured as a long-term hold. If there is a long-term hold, even if the property, think of it this way. Each one of the private equity people are partners that you're essentially partnering with. So they may be limited partners, and they may not have much of a say in certain things, when it comes to operations of the property, but they're still partners. So even if you have paid off the financing, if you ended up getting financing, you fully amortized the loan, you paid it off, your private equity deal is still in place. So they're still getting a percentage of the profits, and it'll continue until the property is sold, typically. Okay, so we look at that. Now we also look at, to get enticement for people to, for private equity persons to give funds to purchase the property, they typically have what we call preferred return. So that could be something like the first 6% of the return goes 100% to the private equity investors. From there, we have what we call waterfalls, where the next waterfall is after they hit 6%, from 6 to 8% or 6 to 9% or however it's structured, 6 to 10%. It might be a 50-50 split with the sponsor and the private equity people. And then typically speaking, there's usually some sort of bump for the sponsors at the end if they really outperform. Let's say it's above 12% return, they might get 90% above everything above 12%. So essentially, the sponsor is not getting as much of a return or payment at all until you get to that point where your returns are actually performing. Another way to look at this is real estate syndications. Syndications are very similar to private equity money. However, they are typically a lot more regulated and structured by the SEC. So, meaning many times you have to go out, you have to find a qualified investor, or QI, okay? And there's an actual definition for qualified investors. So essentially they have to make a certain amount of money per year or have a net worth subtracting their primary residence from that net worth over $1 million. So those are different ways that syndications can work. It's a little bit more structured, a little bit more guidelines to follow to make sure that you're in it. So we see some of those. Now, lastly, and I think we're going to start seeing this a little bit more, is seller financing. Typically speaking, a lot of you guys are old, or younger rather, where you don't remember way back when interest rates were in the teens. Real estate interest rates were in the teens in the 70s. Now, I'm actually a little too young to remember that myself, but I do remember people talking about it. And the whole key during that time, it was not about price, it was about terms. Meaning, if I could get a seller to carry back for 6% interest, I can pay a little bit higher price versus paying a loan at 14% interest, carry me for a few years, and that way my returns are still there. Nice part about seller financing: 1, typically private transactions. 2, less qualifications. Most sellers are not going to underwrite the loan and the borrower as in depth as the lender would. In addition to that, the seller knows the property, so they're not necessarily going to require an appraisal. They're not going to necessarily require environmental reports, things like that. Still recommended that a buyer gets those, obviously, to protect themselves, but the seller, or the lender in this case, because it's a seller financing, doesn't really care as much, and so they're not going to require that. Other things that can affect the seller financing that make it attractive: down payment. A lot of times the down payment is less. Typically speaking, most commercial loans need at least a 35% loan to value. Right now, when we're in a time frame where interest rates are rising dramatically versus the cap rate expansion is not happening as quickly as the interest rate expansion, then what ends up happening is you're going to require, or to purchase a property, it's going to require more down payment because you have debt service coverage ratios that you have to take a look at. So instead of having a 35% minimum down payment, that may be the guidelines, but the property itself, because the interest rates are higher, may not qualify except for like a 50% loan, 50% down. So with that in mind, a seller financing, that changes a lot of that. So, they don't care as much of the down payment. They're going to care about it. But you can also do things like interest only for a certain time frame. The seller can carry the interest only, so you're not amortizing it out. Typically speaking, seller financing is under shorter terms. anywhere from 1 year to 5 years, 10 years. Very rarely do you see it going out 30 years, 25 years, 15 years. Even 10 years is very rare to see, because most sellers, the reason they're selling is they want to take the money out, and they want to take the money out and go and invest elsewhere. You also have to take into consideration that there may be capital gains issues with the seller that doesn't allow him to finance the property as much as he would like, because he's going to have to pay capital gains on the sale. So all that has to be taken into consideration, but ultimately, when we come into it, there are different types of financing and loans that are right for the specific type of borrower and the type of property. So the idea is matching those up so that you can create the best potential return for your clients and make the deal happen. You know, when the debt dries up, or if the debt dries up, like it did back in 2008, 2009, you had to go out and look for hard money lenders, things like that, which typically charge heavy points up front plus a higher interest rate because it's higher risk. Usually hard money loans are 50% down minimum. And one thing that you have to be aware of and be concerned about is during this time, there are predatory private lenders out there. They call it loan to own. So the only reason they're giving you a loan, and it may look like an attractive loan, where they're bumping up, like, oh yeah, I'll give you a 75% loan to value. Only reason they're doing that is because their intent is you're not going to be able to make the payments, or you're not going to be able to make the payoff in a year or two because it's a balloon payment. And their whole goal is to own that property, take it from you via foreclosure. And the idea is that, you put 25% down, so they're actually acquiring this property for 75% of the value that you paid for it. So loan to own, private equity lenders, be aware. Make sure you do your investigations. If you're talking to a bank, you're going to talk to different banks. You're going to get loan quotes. You're going to find out what they do, what type of properties they specialize in. It should be the same for private lenders as well. Just keep that in mind. Okay. So any questions on the financing side?